Hello, from LPL Financial. Welcome to The Talking Point. I'm your host, Quincy Krosby. Good morning, everyone. This is Quincy Krosby. It's The Talking Point. It's Monday morning, July 8th, and I look at the market and the futures are up. And as we know, it is the end of the day that matters, and we see activity coming into the market typically toward the end of the day, either the buying or, shall I say, the selling. What we're seeing in the market right now is a market that is very focused on the data this week. We have the consumer price index, the producer price index. We have Chairman Powell up on Capitol Hill this week, and we have a full parade of Fed speakers coming out this week to speak. But I want to go back to last week for a couple of explanations that are very important as we monitor the market and the signals from the market and the economic data. First of all, we saw last week the PMI reports. Those are the Purchasing Manager Index, PMI, from the Institute for Supply Management. That's the ISM. They have one for manufacturing and they have one for the service sector. And we all know that the service sector, which is called also the non-manufacturing report, happens to represent and reflect the broadest part of our economy. Manufacturing has been in contraction, meaning it is below that very important line of 50. Above 50 is expansion. Below 50 is contraction. So manufacturing has been in contraction across the country. There are some indications that manufacturing is picking up a little bit, but overall, broadly speaking, below 50. The service sector has been above 50 until the last report. It came in below 50, and obviously it is in contraction. Now, if I go under the hood and look at the individual segments, I could say, well, it wasn't that bad. But nonetheless, it did pull back and went into contraction. This, coupled with the payroll report, I do want to mention this because I do think it is very important and it needs an explanation. We saw that the headline number at 206,000 new jobs was above what the market had expected, which was about 190,000 new jobs. However, the 2 months preceding saw a revision, downward revisions. We don't want to see downward revisions. It portends a deeper cooling off in the economy. However, that is exactly what happened. And then the unemployment rate climbed from 4% to 4.1%. 4% was the estimate, the consensus estimate for analysts suggesting what we would in fact see. I could put a positive spin on that 4.1%, and this is what it is. We saw the participation rate in the employment numbers, that the participation rate picked up. And it picked up, you want to see that. You want to see more people coming in and looking for jobs, which is exactly what we saw. Now, if they don't get those jobs quickly, it reflects negatively on the unemployment rate. If they came in and found jobs quickly, the unemployment rate actually could have moved down, perhaps to 3.9%. So that is the positive explanation for that 4.1%. Still, the market saw that and thought, this is interesting, because what we know from historical patterns is that when the unemployment rate ticks higher, it very often, not always, but very often continues to tick higher, goes from 4.1, 4.2, 4.3. But that is not 100% of the time, but it's enough of a pattern that has this market worried that perhaps we are cooling off too quickly. The estimates for GDP for the second quarter have now been ratcheted downward. If you look at one of them that's widely followed by Wall Street is the Atlanta Fed GDP now. For the second quarter, they have revised downward their GDP forecast from 1.7% to 1.5%. This is important because cooling is exactly what the Fed wanted, because the thinking is the more it cools, the more we're going to be killing off inflation. But there's a fine line between kind of cooling off inflation, but also having the economy cool too quickly. So therefore, when we look at the 10-year Treasury yield and also the 2-year, which responded very, very quickly when those payroll report came out, In other words, the yields came down quickly. The question that the market has is this really a reflection of the Treasury market thinking, whoa, this cooling off is happening maybe too quickly and maybe too much? And therefore, because you saw the equity market climb higher, does this mean that the Fed is getting the memo, is getting the message? You got to cut rates. Because remember, Chairman Powell has said, if we see deterioration in the labor market, we will come in and cut rates. And by the way, a number of Fed speakers have come in and said exactly the same thing. But was this enough for them to get worried about the labor market and worried about a cooling economy? And remember the linkage. The linkage is about the consumer, that the consumer begins to get worried about their jobs, holds back spending. And as we represent 68% of the economy, that is not something that the market wants to see happening. But then the other part of it is, what about corporations? What about small business owners? Do they become worried and say, gee, this is not good. Our margins are actually coming in. They're narrowing. Maybe we need to let more people go. That's the train of thought. So it's important this week as we get through the data releases to keep that in mind of what the market may be thinking and may be worried about looking ahead in the summer. Now, July tends to be a positive month for the market in terms of seasonality. The first 2 weeks are typically very attractive for the market. And then the second week holds on statistically to the gains, but then we get into a dicier period in August and even September. Not to mention the geopolitical events, not to mention our own events in terms of the election. But this week is going to be very important. Chairman Powell goes up on Capitol Hill. On Wednesday, he will be at the House of Representatives. He also goes to the Senate. And when he's at the Senate, which would be Tuesday, tomorrow, then the House, typically he reads the same exact speech. So that doesn't change. But certainly the questions change. And maybe his answers stay the same. The thinking right now is he's not going to deviate from what he's been saying. That is, the Fed needs more confirmation before they cut rates. The Fed needs more confirmation before they cut rates over and over again. We'll see. But I can say this, that on the Senate side, we've already hearing the likes of the senator from Massachusetts, Elizabeth Warren, coming out and saying, we need to see rate cuts. What's going on? Why don't you cut rates? People are suffering. And in the House of Representatives, we're going to hear more of that because they represent the local communities and some of them represent areas where the lower wage earners are under tremendous pressure. So they're going to hear, and we'll hear how he answers those questions. Also this week, we have more and more Fed speakers coming out. But in addition to that, we have on Friday, the CPI, the Consumer Price Index. The hope is, and I say hope because the market is hoping very much that we see a continuation of disinflation. Remember that the path down towards 2% had stalled. And finally, it opened up a bit. And the hope now is from the market and expectations from the market is that the disinflation, meaning lower inflation, continues to show up in the Consumer Price Index. To repeat, if you listen to these calls, what the CPI is based on, it's based on consumer surveys. The Fed's preferred measure of inflation, which is the PCE, the Personal Consumption Expenditure Price Index. That comes from corporations, companies telling and giving information about what they're charging. But nonetheless, both of these reports are extremely important. And last time we had the Consumer Price Index report, it did indicate a slight, albeit slower, but slight coming down with disinflation. Also, the Producer Price Index follows. And that is extremely important. We will get that on Friday as well, is that we saw producer prices coming down from the last report. The expectations are right now that it will be a little bit lower, but probably not as low as the last reading. This is what we call consensus estimates. All the analysts coming in and offering their opinion of where it's going to fall. So this week has an awful lot for this market to digest. And if that were not enough, we are going to begin the earnings season in earnest. This begins on Friday with the banks, and these will be the large money center banks. And what we're going to listen for, we will listen for, what are your customers telling you? Are they lending more? Are the corporate companies lending? What are they borrowing? How much? Is it lower than last month? What about vis-a-vis year over year? Also, the ones that have credit cards, this is important. Are they seeing more late payments? Who's paying late? Is it the very low wage earner? Or, and please keep this in mind, is it the group that's just above the lower wage earner? Those are in the lower end of the middle class. Are they suffering? So you can have delinquencies picking up. You can have late payments picking up. What the market wants to know is, where is this coming from? Which group is suffering? Because if it goes up, the wage class, you are going to see, obviously, more problems with consumer spending. So we're going to be paying attention to that. We're going to be paying attention to their view on the economy and their views on, where the economy is headed. And for some of the banks, they'll give a global view. Also, the market wants to know, what about share buybacks? Because they passed the stress tests, and already Wall Street is coming up with lists of who's doing what, or who's going to be buying back more shares, who is going to sweeten dividends. That's what the market wants to hear. So there's an awful lot for this market to focus on this week. But the inflation report is crucial. And obviously the market wants to hear more from Chairman Powell, particularly after that payroll report, and particularly after what we saw in the service sector from the Purchasing Manager Index of the ISM, that's the Institute for Supply Management, that went into contraction territory. I'm going to be paying attention tomorrow, by the way, on Tuesday morning, to the National Federation of Independent Businesses, their optimism index. This to me is extremely important. They are the backbone of our country, the small business owners, and they're focused on sales. They don't want anything to get in the way of what are they going to be able to sell. So we're going to listen to whether or not they believe prices are heading higher. Are they paying more? Because obviously that would be inflationary. And how are they doing? What are they expecting for sales? Are they more optimistic or less optimistic? They, again, are the backbone for our country. They actually are the biggest employers, all told, together for the United States of America. So we want to hear what they have to say. I think it's going to be important, particularly when we are at an inflection point in terms of the economic data. And I think, again, it's going to be a very interesting important. You're going to hear more from Wall Street following it. So overall, a very busy week and a very important week. Just as now, an aside here, I know many of you follow the global markets or international markets, because that does not include the U.S. Global includes the U.S. The runoff in France kept the far-right party called the National Rally Party out. They basically came in third. But it was done as the leading party, if you want to call the centrist, that is President Emmanuel Macron's party, and I'm calling them the leading party simply because they are in power right now. But obviously they were weakened tremendously. But what they did was they made sure that the far left group of parties, and boy, it is a coalition that you really wouldn't want to be in, the far left, very far left that basically hates capitalism, to the ones that are less anti-capitalism, to the climate party, all of them all in together. They got them in together to create a stronghold to keep the Marine Le Pen's party, that far right party, from gaining enough seats to A, have a decisive victory, but even to lead. And in fact, it worked. It actually worked so well that right now that left-wing coalition, that left-wing bloc came in first, followed by Emmanuel Macron, who's the president. His party, which is a centrist bloc, came in second, and the far-right party came in third. However, no one got a decisive victory, which means there's going to be gridlock. We call that a hung parliament. The question actually in the market is, does this create chaos, confusion, or can they cobble together something to keep the government running? They may put in technocrats, meaning they're not necessarily very political, but just to keep things running. Right now in France, the equity market, this is now on Monday, our Monday morning, actually paired some of the losses, and we're seeing dip buyers come in. But ultimately, the market is going to focus. And when I say the market, I mean, when we look at the euro, for example, and the broader market is going to be looking at the yields on the French sovereign debt. Does it climb higher and making the German debt the place where you want to go if you're buying debt? Because if it starts climbing higher, as it did, with that surprise victory in the European Parliament, and then Emmanuel Macron saying, hey, you know what? We're going to have a snap election to see where this goes. That French sovereign debt, it went right up. The yields went right up to the benefit of the German bonds, their own sovereign bonds. We're going to watch this because it will be the reflection of whether or not they can govern at the margin, even though it's gridlock. Can they actually govern, or does it cause so much confusion, paralysis, and ultimately chaos that those yields just push up? But again, right now, the response has been fairly muted. We did see dip buyers coming in the equity market. We'll be monitoring this. Thank you very much. Have a very good week. We'll be back next week. This material was prepared by LPL Financial. It's for general information only and is not intended to provide specific advice or recommendations for any individual. There is no assurance that the views or strategies discussed are suitable for all investors or will yield positive outcomes. Investing involves risks, including possible loss of principal. Any economic forecast set forth in the podcast may not develop as predicted and are subject to change. References to markets, asset classes, and sectors are generally regarding the corresponding market index. All indexes are unmanaged and cannot be invested into directly. Index performance is not indicative of the performance of any investment and do not reflect fees, expenses, or sales charges. All performance reference is historical and is no guarantee of future results. All information referenced in the podcast is believed to be from reliable sources. However, we make no representation as to its completeness or accuracy. Securities and advisory services offered through LPL Financial, a registered investment advisor and broker-dealer, member FINRA and SIPC. Insurance products are offered through LPL or its licensed affiliates. To the extent you are receiving investment advice from a separately registered independent investment advisor that is not an LPL affiliate, please note LPL makes no representation with respect to such entity. If your financial professional is located at a bank or credit union, please note that the bank or credit union is not registered as a broker-dealer or investment advisor. Registered representatives of LPL may also be employees of the bank or credit union. These products and services are being offered through LPL or its affiliates, which are separate entities from and not affiliates of the bank or credit union. Securities and insurance offered through LPL or its affiliates are not insured by the FDIC or NCUA or any other government agency, not bank or credit union guaranteed, not bank or credit union deposits or obligations, and may lose value.